Hello guys, welcome to Leader Skill Academy, a digital online school of excellence. As we focus on providing quality knowledge and skills on data science, we simply offer different areas, that is basic statistics, advanced statistics, linear algebra, and differential calculus. But today we're going to focus on the continuation of basic statistics, where we will be focusing on a very unique parameter called variance, a very unique character called variance. For you to calculate variance, you must understand how to calculate the measure of the center, and that is calculation of the mode, mean, and the median. Good. Therefore, if you are not there when we were calculating the measure of the center, that is mean, median, and mode, kindly don't forget to check on our previous videos. Therefore, without further ado, what is variance? Variance is simply a measure of how the numbers are spread out from the mean in a particular data set. So don't get confused. We're gonna calculate it here on a whiteboard very soon. So what are some of the applications of the variance in the real life? So today I'm gonna focus on application of variance parameter in financial industry. Variance is used to calculate what we call the portfolio valuations. It is used in risk valuation or risk management in a particular level of investments. So we're gonna say that low variance simply means there was a consistency of a particular numbers within a particular investing period. And then if we have the high variance, therefore means the numbers were spread all over. There was minimal consistency. And therefore, for you to calculate variance, therefore you must understand the deviations that occur within the transition of the data from one level to the other. And therefore, that's why it's called the data science. Therefore, welcome. So I'm going to formulate an example here using an investment of a particular company. And this company, we're going to call it company X. Company X. So here we have the company name, company X. You can say company X. Let's say company X is investing in various assets, like let's say stocks or shares in the stock exchanges. So invest maybe in commercial papers. So invest maybe in the real estate. So maybe investing in various businesses like maybe cryptocurrencies, ETFs, and so on. So let's focus on if this company X invests in stocks or shares, investing in stocks or shares. Therefore, we're gonna check the return after 5-day period. So here we're gonna make a table with 2 columns. We're gonna make a table with 2 columns. The first column will have the investment period, which is 5 days. Investment period, and then we'll have the return in percentage. We'll have the return in percentage, a simple start. Then here we have day 1, day 2, day 3, day 4, and day 5. And then we'll have maybe the first day it earned 2%, second day it earned, let's say 4%, 6%, 8%, and then it dropped to 0%. Therefore, if you are asked to calculate the variance of this data or this return, first of all, you must understand how to calculate the average or the mean. Where we calculated the mean by using this formula, the summation of fx divided by n, where n is simply the number of data points, the total number of data points, and then f was the frequency and x was the midpoint, and you have been calculated over here. Therefore, we're going to just sum everything here from the return in percentage, and then we're going to divide it with the number of the data points, or the total number of the data points, which is n. Therefore, the total frequency will be 5 days. We have 5, and then for the summation of fx here, we will sum each value, and then we will divide with the total value here. So we have 2 plus 4 plus 6 plus 8 plus 0. Quick calculations, it will be 10 plus 8, 18 plus 2 is 20. So therefore, the mean value will be 20 divided by 5, which will be 4. So our mean is equals 4. Therefore, we're going to calculate now from this point. We can be able to calculate the spread. So we're going to calculate our variance by equating the formula this way. That is our midpoint. This one is our midpoint, or our data point, minus our mean value, which is 4. We square everything, and then we're going to divide the summation. We're going to divide the summation, the total of the difference between the midpoint and the mean value. Then you square, then we get the total. After you get the total, we divide with the total frequency, which is how often this data occurred in particular investment period. So we have our n there. That's the formula. Therefore, having this data set, we're gonna calculate now. So we have our x minus mean. We have in the first day have 2 minus 4, which is our mean value, square. You add our 4 minus 4 square, and then you add 6 minus 4 square, then you add 8 minus 4, and then you square, and finally you have your 0 minus 4, and then you square. So the total will be 2 minus 4 is negative 2. Minus 1 times minus 1 equals positive 1. Therefore, negative 2. The square of negative 2 equals 4. Plus 4 minus 4 is 0. The square of 0 is 0. And then we will have 6 minus 4, which is 2. And the square of positive 2 is 4. Then we'll have 6 minus we have 8 minus 4. 8 minus 4, which is 4, and the square of 4 is 16. And then finally we will have we will have 0 minus 4, which is negative 4, and square of negative 4 is simply negative 4 times negative 4, which is positive 16. Positive 16. Therefore, the total of this sum will be 20 to be 20 plus 4, that is 24, plus 24 plus 16, which is 40, Therefore, substituting into our formula, the variance will be 40 divided by 5. 40 divided by 5 is equals 8. Then, what does this mean? So this implies that a variance of 8 means that the data value were well spread. So there was what we call consistency. At some point, there was consistency, or there was a spread. There was a consistent spread of numbers during the investment period. That's how simply you can calculate the variance, and then you apply it in the real life. So it depends in which field are you in, and what do you do, and then you can be able to calculate the variance using different sets of data. I will continue with the same class by making a video from the calculation of the measure of the center up to variance level, and then after that video we're going to calculate the standard deviations. We're going to calculate the standard deviation and its application in both basic and advanced statistics. Thank you for watching. Don't forget to subscribe to this channel. Support this channel to provide us with a motivation that will encourage us to make more videos to help the current generation and future generations with quality education, knowledge and skills on data science. Thank you guys.